below current market value. You can go anywhere you want and buy it for 100. I'm giving you a coupon that lets you buy it for 95 for 30 days. You got 30 days, and then the coupon expires. If you don't buy it by then, it expires as worthless. Short term. These are related. Let me make sure I'm getting ready for this one. These are related to calls.
No.
I got some people to laugh. That's cool. The call as well lets you buy the stock, call the stock at a fixed price. The primary difference between these three is this is issued with one price, and that price is going to be above current market value. This is issued with one price, and that price will be below current market value when issued. Calls are issued at any price all the time. Not any price, but up, down, higher, lower, equal. Lots of different calls. One right, one warrant. Restricted stock. This is stock that is owned by people that are under some type of restriction on when and how they can sell it. This is rule 144. That's a gross rule. I need to remember that pun. That's the first time I've seen that. I thought of doing that god awful pun. Employee stock options. Again, not equity. Generally, this is treasury stock. That is stock that the company issued and then bought back. That the company now owns. IBM buys IBM stock. Cool. Then they give that IBM stock that they bought to their employees. Maybe at a discount. Maybe just as an employee benefit. Maybe you've worked for companies where if you get to certain levels, get certain promotions, they give you stock in the company. Maybe some of you have experienced that. Money markets, short-term debt. These are cash equivalents. They can be issued by corporations. They'd issue corporate paper, promissory notes. It could be a government. All governments with less than 1 year to maturity. They can be issued by banks. Banks issue jumbo CDs. These are negotiable CDs. These are not bank products in the way you would normally think. These are securities. These are not $5,000 CDs that my grandma used to go and buy for 5 years or whatever. These are at most 270 days. All treasuries with less than a year, but the other things are 270 days. You also have repos, reverse repos. That's the idea of I'm selling you something, a massive pile of treasuries. You're buying in writing that you are going to sell them back to me in a day or two, or three, or a couple, whatever, handful of days, maybe tomorrow. And I'll give you another 50,000. I'm going to sell you a stack of securities for 100 million. Tomorrow, I'm going to give you 100 million, 50,000 to buy them back. And you must let me repurchase them. That's the whole deal. That's why I sold them to you, for the guarantee that you're going to sell them back. And I'm going to pay you a little bit more. That's your profit. That's why you're doing this. You're not doing it out of the kindness. You a little bit more when I buy them back from you. All treasuries less than 1 year. That is all treasury bills. We will be getting into that shortly. And it's all treasury notes and bonds with 1 year or less until they mature. Any questions so far? I think now is a good time for a break. 0.02. That is how much the par will adjust after 6 months. That's going to be 2% of that's $20. That's 10.20. We then Multiply that by 1.02, which is this, right? That would be after 2 6 months, 1 year. So if we need 18 months now, well, we just multiply it by it again, right? And then after 2 years, we just, whoops, okay, that's so silly. Drawing numbers much. You just have to multiply it by the number of times that compounding. That then tells you what the par value is, and you need to, of course, then find 2%, which is the interest of that par value. That's the math on tips. Is it heavily reported? No. Would I recommend you spending hours studying this? No. Would I hope that if you see it, you might remember it, and that might give you an edge up and you can figure it out? Yeah, that's why I mention it. But I wouldn't bet that you're going to see it. But hopefully, if you've seen it once, maybe when you rewatch this, you'll look at it again. Anyone watching this the first time, rewind and rewatch it again. Maybe taking some notes just on how it works in case you see it. But I actually think one of the three who passed sent me a phenomenal list of keywords that he saw, and he said calculating tips, not the cool kind of tips. These. I don't know what the question was or how it was phrased, but it's going to be something like this. They're going to tell you the coupon of the bond. They're going to tell you the starting par value. They're going to tell you the almost certainly the annual interest rate, because that's generally how it's measured. They might give you the semi-annual interest rate because sometimes they like mixing things up, making sure you're paying attention. So look at that, but there we go. Strips. Oops, what's that? I'm moving. Kathleen, you good? Do you have a question?
A question, yeah.
Okay. I thought I saw you moving like that, so.
Yeah, sorry. So why is it times 1.02 instead of times 0.02? Because I thought a percent was.
What is
okay.
that?
It's the same thing, right?
What is 1,000 times 0.02?
Okay, so I'm really bad at math, so I'm
gonna show, and this is gonna hopefully show you a cool
20.
trick you can use other times. That's 20.
20.
But
right.
that's not what it goes to, right? That's
right.
the extra. So you've got to add the 1,000 to it.
Right. Okay.
What you're effectively doing then is you're taking 100%.
Right.
The 1,000, and a 2%.
Okay.
So you're getting the 102%. That was the 1.02. Similarly, if you're like at a restaurant and you get a bill of 79.82 and you're like, I want to give a 20% tip.
Right.
You can just multiply this by 1.20 and that's the total amount you're paying, including the 20% tip. Okay. Same idea of when you want to increase by a percentage. You multiply by 1 plus that in there. It saves steps by.
Okay.
We good there? And anyone else have a question?
Okay.
Strips. Generally, a T-bond could be a T-note. It has all of its coupons and in principle stripped off and sold. What do I actually have it stripped coming up? No, I don't. I have the bond. It's going to have the $1,000, and then all of these other little coupon payments. What is, say, this $50 coupon worth compared to, say, this $50 coupon that's going to be paid in 20 years later? This is being paid in 6 months. This is being paid in 20 years. It breaks them down, sells them as then zero coupon bonds because you're paying me for this $50 in 20 years. You're not getting anything until then. Once that $50 comes to me because I own this bond, I send it to you in 20 years. But you're paying me today for it. So I don't know, what are you paying me, $10 or something for that? But then you're not getting any money for 20 years. then you get $50. That's a strip. These are where, if the question is specifically talking about a lump sum with a defined, known, specific use and time. I have $10,000. I want to put it into my kid's college fund for 14 years. I want to save for my kid's college in 14 years. I have a lump sum today and 14-year time horizon. I'm not saying I have $100 a month I want to invest. That's not zeros. But if it's a lump sum for a known period, I'll just go and buy you'll just come to me and buy the bond, that coupon that's coming due in 14 years. I've got some in 5 and 10 and 15 and 20 and 20. I've got all kinds of these. You come and get the one for the exact time frame that you know you need the money, when the kid is August of when the kid's going to college or something, July of when the year the kid's going to college. But it's a lump sum. That's one that I think messes with people, because 529 is almost always the right answer, unless it's specifically a lump sum for a target date. Then they may be wanting the zero, the strip. Agencies: Ginnie Mae, Government National Mortgage Association. Backed by the full faith and credit of the United States. It passes through monthly income, and it's taxed at all levels. The other agencies, clearly important enough because I spent a lot of time naming them, didn't I? They're all publicly held. They have semi-annual income. They are taxed at all levels. Ginnie Mae are monthly. You must know that. You must know that they are backed by the full faith and credit of the U.S. government. The other agencies, Fannie, Freddie, Sally, which I think doesn't exist anymore. The Federal Home Mortgage thing that doesn't have a cutesy acronym, a cutesy name. Cash flow analysis on pass-throughs. Use average maturities. The answer to the question is I don't know. Recognize that phrase. I think I actually have some vague idea, but I don't know the analysis exactly. So, and you're not going to need to. The idea is they're going to ask, how do you analyze pass-throughs? And the answer is pass-through analysis is done by average maturities. Not by longest, not by shortest, not by whatever. It's just that sentence. Benefits: high safety, more income than treasuries, but interest, inflation, prepayment, reinvestment, a god-awful interest rate. You pay for safety. Or more accurately, you don't get paid if you're safe. Strips I did mention, the separately trading of registered interest in principal. I thought I had the actual demo here. I need to move this earlier in the presentation. Where is it? Oh, I actually don't have the picture. But this is more detail about it. Do we have questions about the strips? Generally, strips are not. Tips are where people get a little more concerned. Strips are generally more asked. As I said, it's not, I don't believe they ask tip calculations often. They could, and with, 16 people here, and 1 or 2 of you may actually see tips calculations. So just, yeah. Strips are generally considered much easier. Just recognize lump sum. You want to be looking for 0 coupons, and strips are a 0 coupon. Questions here?
I took that bad boy and I don't remember seeing none of that.
It's, you didn't see strips?
I saw strips, I think,
okay.
But
yeah, strips are likely. I would be surprised if you're not seeing questions on strips, or at least seeing them as answer choices, whether they're right or wrong. Tips are not as often tested. That's the thing. Like from the reports that I've been getting, I had one of the three say they saw tips. I'm saying that I'm betting that 1 in 8 or 9 of you are going to see it. I think
Yeah.
it's about 10% or so, but it's incredibly. It's just, in a way, I'm basically just guessing when I'm saying 10%. The data I have is of the 3, 1 saw it.
Yeah, you're absolutely right, Brian. I didn't see tips on mine. I saw more strips. And you were right earlier. I ran out of time, so that's how I missed it by maybe 5 points. Spent too much time on one answer.
It's not your fault. Don't beat yourself up. As I say, I think the test is purposefully engineered for that. There's enough reports of types of questions, and especially when I've taken it and seen it, it just can't be coincidence that every test has setups like that, where there's 3 questions that are sort of related in a row, and then one that's not, but looks sort of related. And if you read in from the previous questions into that one, you're going to get it wrong. And so it's like everybody reports those kinds of things. I can't imagine it's just a coincidence. So yeah, as I say, if you're not at least a little bit scared, you're not going to study hard enough to beat it. That's the other thing. Remember, when people are nervous, I had someone who was saying that they were worried about getting securities because they're worried about losing clients' money. And I'm saying that's a phenomenal thing. That means you know it's important. That means you know you're going to work hard to succeed because you recognize that what you're trying to do for these people, for yourself in this test, is important. It's not something that doesn't matter. You don't need to get nervous about something that doesn't matter, because it doesn't matter. This does. Helping clients does. I brought up to her to try and help her get over it is imagine all of the people out there helping your friends and family who don't actually care, who aren't losing sleep if something happens, and you could help those people with someone who actually cares about them. Okay, any other questions here before we get to one of my favorite cartoons? I love this cartoon. So this is what happened when they tried to build a bond, when the bond issue failed during the building of the Great Wall of China. They got the Great Picket Fence of China. So I do very much enjoy that cartoon. Not as much as Grandma's $5 bill, but that one's coming later.
Brian, that could also be a problem with that could also be a problem with the Great Border Wall, U.S.-Mexico.
Okay.
You better
Corporate bonds. What?
I say you better stop, but he right.
Exactly.
Corporate.
Right?
I mean, this is. I understand as a teacher. I was in high school during 2012. I pride myself in as a professional. As money stops and you can't get more. Yeah, there's a lot of unfinished government projects throughout the centuries, I think. So, but that's what the bonds are for. It's to try and raise money. They can fail. Investment grade bonds. These are high rated companies. They have a higher coupon than government bonds. They're more risky, so they pay more. You could have speculative, low rated junk bonds, non-investment grade bonds. They're riskier. Guess what that means? They pay more, but there's a risk that they may stop paying. I bet you in I think it's a couple of weeks or months. I'd read this a while ago. Maybe they're not doing it anymore because of COVID. But that Toys R Us was trying to come out of bankruptcy and was going to be issuing bonds. I bet you those bonds are paying a whole lot of money. Then again, how long are they going to be paying before Toys R Us actually does fully die? If they haven't already, I don't actually know. Rating agencies. We have Moody's. We have S&P. They get weird with their numbers versus pluses, and this is what they look like. I have had, I believe now, two students on the 65 in the 4 years I've been doing this, two saying it's only on the 65 where they were tested on where this line was. I wouldn't worry too much about it. That line is below triple B. If you're double B, you're junk bond. If you're BA, you're junk bond and below. Again, this has been reported, but very rarely. Questions so far? Continuing, convertible. These convert to common. We explained this with the preferred stock charts. We're getting a little bit more here. Par value for preferred stock, par value is 100. For bonds, par value is 1,000, unless stated otherwise in the question. Common stock par value will never matter on this exam. Never. I don't care if they tell you it's $50. It's just as meaningless if it was the same as Google's par value, which is 1/10 of a penny. You can look it up. It's 1/10 of a penny. I have a copy of their certificate. It's just as worthless as Pepsi Cola's 33 1/3 cents. What exactly is 1/3 of a dollar? Sorry, 1/3 of a cent. It was 1/3 cents. What exactly is 1/3 of a penny? Who cares? It's meaningless. It doesn't matter on this exam. Do not worry about par value with common stock. Preferred and bonds, it matters. 100 preferred, 1,000 bonds, meaningless. No exceptions on common. This is how many shares you get, the number of shares. You can work backwards. If you know the number of shares, you can figure out the other things. The idea to a degree, this is the example that I've been using in other classes.
Yes.
The par value.
Hey,
You have a gift
smell like
certificate
garlic.
to a store equal to the par value. Everything in the store costs the conversion price. How many things can you buy then?
And
That's
this is
the
the mother?
conversion factor. So if you know how many things you're buying and how much they cost, or if you know how much you're buying and how much you've spent, or if you know how much you spent and how much everything costs, you can figure out the others there. If you think of it as a gift certificate for par in a store that only sells things at conversion price, the number of things you can buy is the conversion factor. Convertible value, conversion valuation, parity, equality. Would you rather have, $1,000 bond worth exactly $1,000, or 40 shares of stock worth $25 each? You need the maximum amount of money right now. Which one of these is better?
Stop.
What? Why? How much value do you got there?
Right, aren't they the same value? Just the stock will give you dividends possibly?
So you're asking if I'm capable of asking trickish questions? Yeah, I am. We're talking about parity equality. This is the situation of them being at parity. Now, if you had the question of what if they were $26 each, you take this one. What if they were $24 each, you take this one. But at that precise setting, it doesn't matter, they're the same. So if we have a bond selling for 1,200, convertible at 25. What does the common stock have to be selling at to be at parity? Which means, how much does the common stock have to be at for me not to care whether I have $1,200 bond or $1,200 common stock? How many shares does this convert into? How many shares are we getting?
28.
How'd you get that?
Sorry, 48. My bad.
How'd you get, okay. What's par value?
1,000.
Make sure you don't get current market price and par value confused. The test, we'll do that. The par value is saying 1,000. 1,000 divided by the conversion price is what?
25, so 40 shares.
40 shares. That's what this is going to convert into. How much do those 40 shares have to be worth for those 40? How much do each of those 40 shares have to be worth for those 40 shares to be worth $12,000, $1,200?
Okay. So then that's that divided by that. $30.
That's parity. If the common stock was selling for more than $30, you would want to buy this bond and immediately convert it. If it was selling for less than $30, you would still want to just keep holding on to the bond for the interest, I guess. Do we have questions about that parity? I don't want to spend too much time on it. We've got lots of other things, but hopefully that sort of helps at least.
Excited. I just learned that. I was confused. I had it backwards. Woo-hoo! Thank you, Brian.
You're welcome.
So par of a bond is 1,000 or
Unless it
100.
states otherwise. 1,000,
Okay.
unless it states
Okay.
otherwise. They
Okay.
could,
Thank you.
because likely if the bond states otherwise, it's almost assuredly a treasury. Now, just to be clear, if the bond says they have a $100,000 bond, the par is $100,000, there is absolutely no difference in when you're thinking about what this means to think of it as $100,000 bond or $100,000 bonds. That is the exact same thing. This bond is going to pay 100 times what this bond would pay if they have the exact same interest rate, because there's 100 of them. But that's when you see the larger, it's just bring it down to multiple versions of the 1,000. That generally makes it a lot easier to think of, and that's how I always think of them.
Thanks so much.
Callable. Issuer may force investor to sell bonds early. I did add puttable here. Puttable, investor may force issuer to buy bonds early. I forgot what I guess I added since last time. Munis. This is what the what builds the schools, what builds the courthouses and police stations and things that may or may not get fully funded if things happen. Muni bonds are interest federal exempt. They do not pay federal income taxes. State and local, they might, usually exempt from state and local as well, provided they are bought in the same state as issue. I, living outside of Philadelphia, Pennsylvania, if I was to buy a Harrisburg, Pennsylvania bond, it would almost assuredly be triple tax exempt, state, local, and federal. If I bought a Dallas, Texas bond, however, it would be federally tax exempt. They're all federally tax exempt. It would not be state and local because it's out of state. Now, yes, there are states that don't have state and local investment taxes. And so, yes, if you buy an out-of-state bond, they would also be state and local exempt because you don't have state and local taxes for that. Capital gains are taxable. If you sell a security for more than you paid, it does not actually have to be in that order. But if at the end of whatever transactions, if you bought it for less than you paid, there's a capital gains, even on municipal bonds. The income is exempt, not the capital gains. They're good for a high tax bracket. If the question is specifically mentioning a tax bracket, start thinking munis.
My question did that, and I chose for high tax bracket. It was a question specific, just like.
Yep, almost like I've seen these questions before. Yeah, they're gonna ask a bunch of tax questions. We have a whole unit on taxes. I think that's
Oh,
also
God.
week 3. Yeah, I don't make up what's on the test. I just have a job teaching you what's there. So here we go. GOs, general obligations. This is backed by taxing authority. Schools, police stations, city hall. You also have revenue bonds, RBs. These are backed by a specified revenue stream. Toll bridges. My parents still tell the story of when they first met. They lived in a town, I forget where. I think it was in Ohio, where the town put in a toll road. They needed to build a bridge, and the town swore once they finished paying for the bridge back, they take out the tolls. And my parents, like I'm sure you guys, are sitting there going, yeah, right. They're going to take, they did. As soon as they finished paying the bridge, they actually took up the tolls. They stopped it. They removed them. My parents were shocked. I'm still shocked that they would do that because God knows they would never do that now. Why give up a perfectly good source of revenue just because you promised? Pfft, what politician does that? This is the formulas. Of all the tests, certainly the 65 is where you're going to see this. The likelihood, actually, now that I think about it, because the idea municipal rate, you could see that phrased as the tax-free or the after tax. After tax, before tax, yeah. There's a reason why I have this formula in here. You should know it. Now, the issue is I tell people this is the only formula you need. Just that one. What is 100 minus t? Let's go through this logically. If we internalize it, we can just remember it. Well, if we're paying t, aren't we keeping then 100 minus t? If I'm paying 30, 100 minus 30 is 70. Isn't that what I'm keeping? If I'm paying 30, I'm keeping 70. If I'm paying 40, I'm keeping 60. 100 minus t is simply what I get to keep after taxes of the corporate, which is taxable. Of is multiply. If I multiply what I get to keep after taxes times what I'm getting, that's what the municipal has to equal for them to be equal. Equal means, would you rather get $70 a year tax-free or $70 after you pay taxes? Well, last time I checked, 70. Now, why do I say this is the only one that you need? Because of it, everyone looks like they're sitting down. I got to be prepared because when I mention this word, sometimes people start having seizures. You only need to remember this because of algebra. Is everyone still with me? Whenever I mention algebra, some people start having seizures and things. And it's the idea, if you remember back, multiply, divide, or add and subtract. If you do the same thing to both sides, nothing changes. If we divide both sides by that 100 minus t, that gets rid of it over here, leaving us this equation. So if you memorize and internalize this one, you can then just build the other one. You don't need to memorize both.
Brian, could you put some stuff to it? Like, because that is on the test. Exactly.
I mean, there's a couple of ways. you guys have to pull out the calculator. I'll pull mine out and get ready because I'm
I
just
got
gonna
my
pick random
calculator right
numbers.
here. Look,
I'll just pick random numbers here. That we've got a 9% corporate, and you're in the 28% tax bracket, and they want to know what the municipal equivalent would be. What would the after-tax yield be? What would the tax-free equivalent yield be? What would that's probably about all the ways they could phrase it. All those things mean the same thing.
missed it. 9%, 28.
What are you keeping? I would guess that in my head now that I look at it. Christy,
Could you ask
what'd you get?
Could you ask the question again, Chris?
If you've got a 9% corporate bond, you have a client, and I can't put up answer choices because without spending some time coming up with decent distractors, it may be too obvious. You've got a client who's looking at a 9% corporate bond. They're interested, they're in the 28% tax bracket. They're wondering what rate a municipal bond would have to pay to be equivalent.
%6.75%.
Which one?
6.75%.
How'd you get that? Because you're close. And I'm looking and checking and making sure I didn't do something wrong.
6.48%.
I got 6.48.
So
What I got, Bry?
6.5%.
I mean, yeah, that's likely 6.5% is going to be the answer. I mean, if they have 6.5 and 6.8 and 6.2 and 9.8, because not, I mean, yeah, they don't have 6.48, but that's not that one. That one's the closest.
Okay. Thank
and
you.
they could certainly ask it the opposite way.
Okay. Thank you. Brian.
Where they're going and saying, well, you've got a client who is considering a 6.5% muni. What corporate rate? What taxable equivalent rate would a corporate bond be? And when you do it this way, you go, actually, nope, sorry, wrong one. You would have to, if you wanted a straight equation, you have to do it this way. You'd have to do the 6.5 divided by 0.72. Then again, you are going to have an A, B, C, and a D, right? You're going to have 4 choices. And if you take whatever number's here and multiply it by that, and here by that, and here by that, and here by that, only one of them is going to give you that as the answer. And there you go. Another reason why you really only need that one equation. Because either you go from the question, plug the question in here to get the answers, or you go from the answers, plug the answers in here and see what number comes out that's in the question. There are a lot of equations on the 65. The fewer you have to keep memorized, the better.
If I recall, you don't get to use a calculator in this, right? You gotta just do it.
Calculator, oh, you do. At home in the test center, it's in most cases, I believe it's built in. I've had some people say that they actually do not get to bring one.
You gotta ask them because they just want you to. I need one at my desk.
There's, I mean, it's also potential that because I don't believe there's multiple systems. I think everybody tests in the exact same system. So I think everyone has the digital calculator built into the test software. But some test centers, I've never asked for it. I didn't see them, so I don't know. They certainly could be there. But I've had some students say they were given physical calculators as well. So you may be able to ask for it. You can't bring one. I cannot imagine they would ever, no matter what you possibly brought, they would let you bring in there. Just because they can't check all the circuitry and everything, and they don't know if you're a Chinese hacker who put in secret microphones or something. They make me take off my glasses so they can check and make sure that they don't have a camera or one of those Google Glass things. Yeah, they're not going to let you bring in even a 5 function calculator.
No, they're not.
What
You have to
question
be
here?
naked.
Say it again.
I said, no, you're not. You got to be naked going in there. I'm just-
Make you take out your pockets, and that's the other thing that I tell people about the psychology of the exam center. It's not, they're not making you strip. They're not rubbing you down. They're not like invading that, but they are making you empty your pockets, pull them out, take off your glasses. If you wear a watch, certain rings I've had to take off. It's uncomfortable like that. I like their rings and maybe their necklaces that they're not allowed to wear. They were given this watch by a loved one, and they like looking at it to remember. They can't. So there's all these other psychological aspects that really start getting in your head that you need to make sure you keep out.
Wear no jewelry. Keep it off.
Yeah.
No, nothing.
I always take it off and leave it in the locker because I like my rings. But yeah, I have ADHD, so like I normally play with my rings. But
Brian,
without
I'm a
them,
little
I can't.
confused on where we got this. Where did we get the 0.72? For some reason, I had 0.70. What am I missing?
I gave you the 28% tax bracket. You may have misread what the number was. My handwriting, I'm sorry. I'm trying, but sometimes like that's 100, not a 6. Sorry.
Got it. Thank you.
Yeah. Foreign bonds. Oh. Was there another question there? Someone just texted me something important. Okay. Risks and advantages. Foreign bonds again now. Government debt. Could be corporate debt. Same as in here. Foreign companies have mismanagement just like American companies do. Foreign companies go out of business just like American companies do. The same risks and advantages plus, I guess I don't know why I didn't add that here. It adds some other potential risks too. Currency, sovereign. Depending, of course, now if you're investing in like German bonds, you don't really have sovereign debt. Germany's not going to be going out. If you're investing in Belarusian bonds, there may be some political changes happening in the country that just had the leader say the only way you're getting me out is if you kill me. There may be some problems when there's riots in the street and the president is literally daring his people to kill him. I found that story hilarious this morning when I read that. Like, that's not what you do when your people are mad. You don't dare them to kill you. But anyway, when you're dealing with these other countries, there could be other risks, but they're all the same as ones here. Business, credit, all those things too. You have Brady bonds and Yankee bonds. Boy, do these rarely get seen. This is one of those where when people come out of the tests, all the tests, I basically want 3 questions to be thought about for. If you want to help me out and thank me, 3 questions are what I'm looking for. Anything that I said that you would see and you didn't. Anything that I said you wouldn't see and you did. Any words, phrases, ideas, concepts that made you just go, what the heck does this mean? Because those words, phrases, concepts, and things I try and sort of throw on like this is Brady bond, Yankee bond. Oh, right, I added another one, Euro bond. Just so that if you happen to see them, you have some hopeful idea of what they are. To at least eliminate things. That you at least recognize that these are foreign bonds. They're not investing in U.S. companies. And likely 2 of the answer choices are going to be something about U.S. companies, which they're wrong. Eurobonds are the one of the important things about Eurobonds is that they're not it is the name. They're called Eurobonds. That's not European. You could have a Japanese Eurobond. Yields, nominal yield, the stated yield, the coupon yield, all the exact same. Means the same thing. The current yield is the annual income divided by the current market value. What is very, very important for the 65, I mentioned in other tests and classes, but it's very important here. Capital gains never counts. They are reasonably likely to ask you about some investment that paid out dividends of $10 with a $5 capital gain, and it's worth $50. What's the current yield? And you go, oh, well, I paid 5 and 10, so I paid out 15 annual income divided by 50. I guarantee you that's an answer choice. 30% is absolutely going to be an answer choice. It's the wrong one, but it will be there. Guaranteed. Because you can't include that. It's just the dividend. The answer is 20%. Capital gains never counts. Also, read the question carefully. If they're talking to you about a bond or something that's paying, let's say, $1 a quarter, and it's worth $20, what is its yield? What's its current yield? And you go, oh, it's paying $1. So 1 divided by 20, and you're going to get 5%. Another time, I will guarantee you that will be one of the answers. That will be there. Guaranteed. It's wrong, but it'll be there. Because it's not paying $1 a year. It's paying $1 a quarter. That's $4 a year. That's 20%. These little math things, I haven't had to do them before, but they are getting reported. Yield to maturity and yield to call. Really unlikely to see yield to call. Yield to maturity is also known as the basis. It represents your money that you get if you held the bond to maturity or held it to call. Yield to call, I share my picture coming up here. I guess I should probably move that around a little bit, make it easier to read. Let's see. Let's highlight over. We go like, there's the red line. There's the blue line. And here's the green lines. That works. You need this chart. You may have seen it going the other way where premium's on the left or I have a premium on the right. It doesn't matter. It's the exact same information. The important thing to know is on a discount bond, nominal yield is less than current yield is less than yield to maturity. That again, on a discount bond, yield to maturity is higher than current yield, is higher than nominal yield. Recognize both directions. In a premium bond, nominal yield is higher than current yield, is higher than yield to maturity. Similarly, going the other direction, yield to maturity is lower than current yield, is lower than nominal yield. Again, on a premium bond. Yield to call only matters on premium bonds. Why? Why do bonds get called? They get called to refinance the debt. When do you refinance? What do interest rates have to do for you to refinance?
Go down.
They go down. Why do bonds go premium? Because new bonds are being issued with a lower interest, meaning your older bonds have a higher coupon. The coupon's fixed, it never changes. So the bonds you bought 5 years ago are paying more than the bonds that people are buying now for the same $1,000 you paid, which means your bond is worth more because, hey, look, interest rates went down. The same thing that causes a bond to go premium is the same thing that causes a bond to get called. That's why it only matters on the premium bond. And because it doesn't get to maturity, it gets called here. That's why it happens before. Let's see how we do. So if you bought a bond at a premium, would you expect the current yield on the bond to be what? I mean, once you got the cricket sound, I mean, there's some others that you just have to get. I mean,
It's at a premium. Say your question again.
Oh, sorry, I didn't realize they hadn't loaded. I'm sorry. It was on my screen. I'm sorry, I've too many screens in front of me and I wasn't paying attention to what you guys were seeing. Sorry. If you bought a bond at a premium, would you expect the current yield on the bond to be what?
C, lower.
Lower.
Need to know the current rates. No, it's at a premium. That means it's high. The current yield. Oh, expect the current yield.
Understand as well, although not always generally on the test, the answer is not going to be that you need more information. It could be, but generally it's not.
Lower.
Here's the teeter-totter.
Yep.
We bought it at a
Lower.
premium, right?
Lower.
It is lower.
That's what I got on my paper.
The client has $100,000 to invest and they're looking to maximize current income. Maximizing current income is the same as the maximizing current yield. So what this is asking is which one of these has the highest current yield. One of these is dumb on the face. One of them with a little bit of work is clearly wrong as well.
Corporate bonds still on a discount with 6%. Woo! D.
Remember, with maximizing current income, we're looking for current annual income. What's the annual income of this one? How much is that paying each year?
Zero. It's
a zero coupon bond. It has no current yield. It can't be that one. And if you remember, well, par, a discount could be higher, could be lower, or a premium could be higher, could be lower, depends on which one. And par is straight across, so it's neither higher or lower. So chances are, since a premium is higher or lower, discount's higher or lower, depending on which way you're going, it can't really be par, can it? Because no matter what, one of the others is going to be higher or lower, depending on the situation.
Is that the one with just the
So
phantom
it's
tax?
50-50. What?
Is that the one with the phantom tax in it?
The zero coupons do.
Okay, yeah.
Zero coupon, yeah, I guess I didn't mention that. Zero coupon bonds, the apparent income that you might be earning. The idea, let me actually we'll close this and we'll go down here real quick. The idea would be that if I paid $500 for a bond that's going to mature at $1,000 in 10 years, I'm making $500, right? Over 10 years. So effectively, you can think of it as making $50 a year. All with me? I did that quickly, but hopefully.
Yes.
Okay.
I just have
this $50 a year is taxable this year, even though you did not get it. Just like it's going to be taxable in this year and this year and this year and this year. All 10 of them. Which means when you get this $1,000, I paid taxes on 450 of it already. So when I get this 1,000, I don't know very much in taxes because I've already paid 9 years worth. This final, I pay the 10th year, $50 again. Everything else I paid. That's the phantom tax. Zero in common stock will not, oh wait, where's the common stock one? I didn't have common stock. I guess I changed that from a different wrong answer before. Maximizing income is maximizing current yield. Which one of these has a current yield that is higher than its stated nominal? We don't know what it is, but I can tell you that that premium is less than 6 and that the discount is more than 6. And which number is higher? One that's less than 6 or one that's more than 6, which is going to be larger in pretty much all cases, right?
More than 6.
Higher.
Even if it's 5.99 and 6.01. Questions here? Yield curves. Generally, the shorter the maturity, the lower the yield curve. That is a normal yield curve. Sometimes the opposite happens and an inverse yield curve exists. It's generally the rarest of the three. It predicts recession. In the past 60 years, the yield curve has gone inverse. I think it was 7 times, 8 times, 8 times. And within, I think it's 8 to 18 months after, every single one of those has led to recession. Rarely do all maturities have similar yields, but they could. That would be a flat yield curve. This is normal. Short-term low yield, long-term high yield. This is inverted. Short-term high, long-term low. This is flat. I said initially 7, then I pointed out 8 of the recessions. Because in May of 2019, the yield curve inverted. And hey, look what happened 8 to 18 months later. Pretty sure that's 8. It might be 9. I forget. Perfect correlation.
Can you say that one more time?
In May of 2019, the yield curve inverted. And hey, look, 8 to 18 months later, here we are. And we are in a technical recession. We have had 2 quarters of negative growth. That is a recession. Now, we may be growing out of it. It may only be 2 quarters. But we did hit recession 8 to 18 months after the inverted yield curve. Correlation does not imply causation, but man, does that look impressive. Jonathan? Okay, I saw your box light up. Wasn't sure if you had a question. This is where I talk more about the zeros and I get into the fandom. I knew I talked about that somewhere. Zeros are sold at a discount. Always. Well, in normal times, always. I think there was a time in 2008 where they were selling at par because that was a scary time. The duration is going to equal maturity. The longer the duration of a bond, the more susceptible to changes in interest rate risk. The more when interest rates change, the bond will change. The shorter the duration, the less they will change. High or low. Long duration bond, when interest rates go down, is going to go up more in value as well. Not just potential for down. I think we got 34 slides left and we're hitting options now, and that's always a good time for a break. Let's take another 10. We can do 15. I think we are definitely way ahead of schedule here. So we'll come back at 48. So 12 of the hour. Sound good, everybody?
Yes. And when you come back, could you go back over that normal and inverted stuff again?
I can try.
Okay.
I will talk to you guys back then.
Okay. Bye-bye.
shorts, like just no shame, which is always great for when you're dealing with trying to be funny. No shame. And he came out and just was singing this song that I didn't recognize at the time until Wrecking Ball came, and then like he just started beating these balloons around the stage in perfect time, and it was just, it's hard to describe just how unbelievably hilarious it was. I was crying. And yeah, so that was my meeting of that song, and always wanted to do something funny. Always wanted to do something funny with it, and I found the breaking away wall footage, and I'm like, wait a second, there's that song, and took a while to build it, but I think it works well. Okay, someone wanted to see. Wanted to go back to this one.
Just that illustration of the nominal, the inverted, and flat.
That's not where I clicked.
And I saw Miley Cyrus swinging on that ball as you was.
I've tried to, because I've tried to get a actual wrecking ball in there, but it looks so bad. And I could not find an actual like wrecking ball destroying a wall that I could edit into this, but I will continue to be trying because I really would like to make it perfect. So do we have a question on here? You just want to see this pic? This isn't in your notes? I didn't think, I'm surprised I didn't delete. I cut this, I'm sorry. Uh-oh.
It's in the book, right? The book you
Say it again?
It's in the book.
No.
Oh, it is? Okay.
Whatever.
I didn't spend as much time this time double checking to make sure about the pages, because I think my system was, I built an Excel spreadsheet to do it for me. And the first time I had to make sure it was all good and it worked. This time I sort of trusted it, so I'm hoping I didn't leave pages out by accident.
No, you didn't. I got it in there. You just went through it real fast.
It's not, I mean, the problem with so much of this is, I don't want to say that you're not going to see it, because yield curves actually are highly reported of one question. And they're not, it's not a horrifically deep concept. So that's why, I mean, yeah, but if you have questions, please ask.
Keep going. I got it. I'll get it.
So now we're back here with derivatives and options. Oh no. Close that. Let's try this again. So now we're back with derivatives and options. There we go. That's the sound effect that we're supposed to have. All these derivatives, all these options are going to have a strike price. Puts and calls have a strike price, an expiration date. They have a cost. That's the premium. They are standardized. Every options contract is for 100 shares. Puts, the buyer is bearish. The seller is bullish. Buyers put down. They're betting the stock price will go below the strike price. The break even is the strike price minus the premium. The max that you can gain is also the strike price minus the premium. That is a happy coincidence. They are not directly related. Just so happens that they're the same number. Call, buyer is bullish. Buyers put down. Buyers call up. The seller is bearish. The sellers think the buyer is wrong. They are betting the stock price will go above the strike price. The break even is the strike price plus the premium. For the buyer, the max gain is unlimited. They're betting the stock's going to go up. How high can a stock go?
To infinity and beyond.
Well, not quite, but pretty close. Limitless. Not that kind of naked. The little 8-year-old boy in me still giggles when we think about naked versus uncovered calls. This is selling a call without owning the underlying security. There is unlimited risk. If it's a covered call, that means you do own the securities. Meaning if the call gets exercised, the buyer is going to make you sell them the securities. If you don't already own the securities, you have to go and buy them at a limitless price. But if you own them, you just have to give the shares you already own. It's a covered call. It's important to recognize writing calls are both the most aggressive option. Naked calls have unlimited loss, finite gain. There's a maximum you can gain, unlimited that you can lose. Writing a call is the most aggressive, the most speculative. It also is the most conservative if it's covered. You can write covered calls in UGMA and UTMA accounts. It is the only option you can do in UGMA and UTMA accounts, covered calls. Here's one of the charts. We go through a couple of them. Buyers call up, buyers put down, sellers think they're wrong. Also remember, bulls attack up, bears attack down. What may also help, because sometimes you might imagine that a bear might attack up, so you got to be careful there. Just remember, as you're walking through a forest, you don't need to look up in the trees to make sure the bulls are going to jump down on you. There aren't going to be bulls in the trees jumping down on you. Their little thin legs would be sort of funny to see them climbing trees and things. Bears might be in trees. Bulls are not going to be in trees. Thought more people might smile at that one. I like that joke. Mark it up. Mark it up. You're a bull. You've got 3 choices. You could buy a call. You could sell a put. Or you could go long the stock. Long the stock is what we normally think of when we're thinking about buying stock. You're long. You're buying stock. If you mark it down, if you're a bear, you could sell a call or buy a put. Notice the buys are in red. Those are the best choices. If you were right, of the 2 options in each category, if you were right, the buy side has a much higher profit potential in both puts and calls. Shorting a stock, that's a bit trickier. The idea with that, I don't think I go into it in huge detail here in the 65. There may be another slide later. We want to buy low and sell high, right? Always buy low, sell high. If you buy high and sell low, that's how you lose money. Always buy low and sell high. But what if we could switch that up? Now, we don't want to buy high and sell low. That's how you lose money. Always buy low, sell high. Buy low, sell high. What if we could sell it high and then later buy it low? That's shorting the stock. That's short selling. You were borrowing the security from someone. Hopefully the price goes down for you, hopefully, so you can buy it back later at a cheaper price, keeping that difference as profit, and that is a capital gains. You bought it for less than you sold it for. I told you earlier, the order doesn't necessarily matter. You could sell it for more than you bought it for, or you could buy it for less than you sell it for. I then go and give the person I borrowed it from back his shares, and I keep the difference. I'm also giving them some interest, but I made the money when the stock went down. That's short selling or shorting a stock. Questions on these? Oops, dropping stuff.
So Brian, can you go back once, right where you was at? When you're saying pick one in a row, so you're saying market up bull, you're saying buy a call or sell a put long stock, that you're
Yes.
going across that away?
Yes.
Okay. Thank you.
Some more vocabulary. The writer is the original seller. I use Johnny. Johnny is my imaginary friend. He's got a very boring life as an imaginary friend. He lives in the corner of my room, and all he does is write my options. Whatever I need, he's the writer. He's the original seller. I bought an option from him. Put, call, I don't care, whatever. A couple weeks, couple months later, I'm like, I don't want this anymore. And I end up selling it, say, to Jeff. I am not the seller. I sold it, yes, but I also bought it. I have bought and sold the same thing. I'm done. I'm out. Johnny has only sold it. Jeff has only bought it. They're the ones that are in. Johnny is the writer. He's the seller. Now, Jeff is the buyer, the owner, the one who controls the choice, the one with the choice, the right to exercise. If the buyer says jump, the writer's only choice is, okay. If the buyer says, I am calling this from you, the writer must sell it to them. If the buyer is saying, I am putting this to you, the writer must buy it from them. The writer does not have the ability to say no if the buyer says do it. The idea of puts and calls is there what's called a zero-sum game. That is a phrase from a math class called game theory. Likely many of you have never heard of. Don't worry about it. Most of it's rather boring, but sometimes they get cool things. But they go and they play games and classify different types of games. One of the bigger classifications is a zero-sum game. It's what most people think of as a game. It's a game that if you and I were playing, for me to win, you've got to lose. Or for you to win, I have to lose. We both can't win. We both can't lose. Not in a zero-sum game. Every point I get, let's say 4, means you've lost. Lost 4. If you add them up, sum them up, they always sum to 0, hence zero-sum game. Same idea with puts and calls. You could have a day in the market. Let me see if I can find this quickly. Today, sort of mixed. Looks like S&P and Russell are both up. Dow is down. So it's sort of mixed. But I could look at my tracker up there, and on days where basically everything that I'm looking at is green, I could assume that the majority of people in the market is happy. There are days where I look up there and everything's basically red, and I would assume that everybody or the majority of the people in the market are sad. That doesn't exist in options. You cannot have more than half of the people happy, because the reason those half are happy is because the other half are unhappy because they're paying those happy people. There is nobody else. The buyer and the seller. Every dollar one is making is because the other is losing it. There's nobody else involved. There is the strike price. This is the bet of the option. When an option is exercised, put or call, someone gets cash, someone gets stock, the other one gets stock. If I'm calling stock, right? If I'm getting stock, means I'm giving him cash. If I'm putting stock, sounds like I'm giving him stock. He's getting stock. I'm thus getting cash. The cash is the strike price. The expiration is the date the options expire and become in value. I'm not saying they get close to 0. I'm saying they become worthless. People think Lehman Brothers went worthless. Lehman, from the records that I've been able to find, went from somewhere around 58 to 8 in a day, less. Now, if you had a whole bunch of money at 58, and then one morning it's now worth less than a dime, you might think that you've basically lost everything. You technically didn't. You could still probably buy a pizza at least, maybe. I don't know how much money you had in there, but at least you could buy a pizza with what you got left. That's not zero. When I say worthless, if these were printed out on paper at expiration, or after expiration, I should say, value of that piece of paper is its use as a fuel source, as in lighting it on fire and using it to generate heat. That is its only value. Worthless. Premium is how much you paid for the contract. The contracts are again standardized. They're 100 shares. So the price for the contract is the premium that's going to be stated times 100. The break even, I mentioned that we both cannot win. We both cannot lose. We could tie. If neither of us get a point, that means neither of us lost a point, and it's a tie game. In a zero-sum game, ties are absolutely possible. This is a tie game. If I'm betting it's going to go up and you're writing it, I am paying you money up front. I am out, you are up. If it goes up exactly the same amount that I paid you, the premium, you're then paying me that back because that's how much I was right. If I pay you $10 and you pay me $10, how much did each of us make or lose? We broke even. The equations are in here, but there's a cleaner form. I think this way looks better. Now, for those of you who've taken the SIE, I believe there are more options questions on the SIE than on the 65. I'm not saying a higher percentage. I'm saying flat out more. And there are about half as many questions on the 65. A lot higher percentage of the 65 is options.
Yeah, Brian and Snyder, I didn't see much option test on 65.
I generally will tell people 2 to 4, 3 to 4 questions you should expect. But again, in most cases, they're relatively easy. They're not the math that the SIE had. It's more of the why someone would do this. Why would you? You've got a client who's worried about they do a Japanese import-export business with Japan. And you've got a client who's very worried that the dollar is going to go down and it's going to impact his business. This question, I've seen this test and it's been reported as well. Do you buy a call on the dollar, put on the dollar, call on the yen, put on the yen? All buys. Now this is one, and there's a reason why I mentioned this, and I do think I mentioned this in most of my classes, or at least try to for the 65, because as I said, this does get seen. Well, the dollar going down, that sounds like you buy a put. Then again, if the dollar is going down, that means the yen's going up. It means we buy a call. Huh, 2 answers. The fact that I bring this up is just because it's important to know you cannot buy options on the dollar. They don't exist. You cannot buy options on the dollar. If you believe the dollar is going to go down, you must buy the call and exist. So even though it looked like 2 answers, there's really only the one. You buy the call on the yen. That's the type of questions that you might see on the 65. They're not likely to be getting into these well, not as much. Much more of the sort of theory than the actual application of options. Are we good here? There it is. forwards and futures. Producers will be selling, and they sell to decrease volatility, to limit future price risks, to lock in profit. An example of this, imagine I'm a rice farmer in ancient China and I plant my crop. I have no idea of the times, with just making it simple. I plant my crop in January and it's going to be ready for harvest in October, and I take it to market to sell. What do I do for those 8 months until it's ready? Because I don't have anything to sell and I don't have any other skills other than being a rice farmer. How do I make money? What if I go and I find a trader who's willing to buy my rice now? I'll deliver it in October. They're paying for it now in January. So for those 8 months, I can go and actually buy food and survive and support my family. And then when the rice comes in, I deliver the rice to the person who paid me already. What if the rice went up in value? And that sucks. I could have waited and made more, but I was able to eat, and the guy I sold it to makes more money. What if rice goes down in value? Well, I guess I'm glad that I locked in my profit now. He already paid me. These are the ideas of futures and forwards. There's a big difference between them, though. We're going to get to that in a moment. Consumers buy. Decrease volatility, lock in. These are in a no, these are not securities. These are dealing with like potatoes. The example that I always give about these is McDonald's. Do you think how many people at McDonald's right now are going around the country talking to farmers to make sure that they have the potatoes they need in their restaurants for next week? You think they're buying their potatoes for next week now? I mean, if you go to like a nice fancy restaurant, they might be buying their potatoes for next week now. Think McDonald's is? Or do you think that maybe McDonald's is buying their potatoes next year right now? That they're already locking in the supplies for next year or the following year? Because this is what they're doing. The farmers are selling, McDonald's is buying them. The difference between them, futures are standardized. They're exchange traded. They're regulated. And they don't usually deliver. This is not what McDonald's is buying. Forwards usually do deliver. They are not standardized. They are not liquid. If McDonald's went and bought 723.82 tons of potatoes, and that's what the forward is, whoever's going to try and buy that must be willing to accept the 782 point whatever I said potatoes. They can't change it, and every time McDonald's writes one of these or buys one of these, it could be different. Futures are standardized. Forwards are not.
So what does the phrase "rarely deliver" means?
If I'm worried about the price of soybeans. You are a producer or whatever, or you actually are also worried about the price of soybeans, but on the other direction. So you sell one of these soybean contracts. I buy it. It expires in 6 months. In 5 months from now, I sell it back to you. Or I sell it to someone else and you buy it from someone else, and so you close it without actually having to accept delivery of the soybeans.
Okay.
It's a bit weird. The idea is just remember, futures rarely deliver, forwards usually deliver. If the question asks it, that's what. I mean, these are investments that I don't deal with. These are commodities and stuff. I don't.
Okay.
Yep. Other questions here? So I've got 5,000 tons of copper for your swap traders on the 4th floor. Where do you want me to put it? The idea for this cartoon is that one of their traders apparently mixed up what futures and forwards. Oh, for those of you who didn't get them, I emailed the notes earlier, yesterday. I certainly can do it again. They're going to be on the website. Everything, all the links and everything is on the website. If you have troubles logging in, let me know and I can certainly help. But all the links for future classes are going to be on the website. I'm not going to be emailing them each week. Insurance investments, annuities, life insurance. Yes, they are not actually investments, but sometimes they get close enough that the test, we need to deal with that. Indexed annuities. These are not a security. Now, ask me in 5 or 10 years. I'm not convinced the answer is going to be the same. The cash value is tied to an index. We participate in the growth with the cap and the gains, but likely not in the losses. Meaning one bad month could really wipe out everything in an indexed annuity. It's designed to reduce the purchasing power, the inflation risk of fixed annuities. Variable annuities reduces inflation risk of fixed annuities. That was their purpose, but they are a security. Purchases are directed into a separate account. Living benefits riders are used a lot. Make sure you do not think about them on this exam. There is no GWB. There is no lifetime LIB, lifetime income benefit, guaranteed withdrawal benefit, annual step up. None of that is on this test. That's one of the problems with annuities, especially if you've got experience in the industry. The annuities in the industry are good. The annuities you may have made a bunch of money selling are great, wonderful annuities with wonderful riders that actually help people. The annuities on these tests are garbage that you just have to know because that's what's on the test. So which of the following are not securities?
A universal life policy.
Just universal life?
Oh,
And you gold bars.
Option or mining company,
Options aren't securities, are they?
right?
Options are a security.
They are.
Yeah, derivatives.
That's where you start getting weird, because I'm quite sure that forwards are not securities. Futures I don't believe they are. The issue is that options on them are. Buying pork bellies is not a security. Betting on the price of pork bellies is a security. If that makes any sense, hopefully. So which of the following are securities?
a variable annuity.
Variable and variable life.
Variable life and variable annuity.
When they say variable.
A variable.
I forgot that this got tuned too. One of the good things about living so long is I'm upsetting the people who are paying my annuity.
I need to stop.
Like that one.
Beautiful.
That was funny, right?
Other insurance stuff. Fixed annuities offer a guaranteed rate. Inflation risk, they are not securities. Life insurance, useful in planning, but not an investment unless it's variable. And even then, it's still not really an investment, but we can talk about that another time. Hedge funds, form of a pooled investment. Generally organized as a limited partnership with less than 100 investors. It does not register with the SEC, but typically the manager does. The fund itself is not registered, the management is. They use riskier investments, options, derivatives, shorting, leverage. The goal is to preserve capital and deliver positive returns in all market conditions. There are basically 3 market conditions: up, and making money in up market's easy. You buy something and wait. Make money, it's easy. Flat and down, not so easy. That's why they use all the complicated stuff. Making money in flat and downs require complicated, risky stuff. Generally much higher fees. If you see something about like a fee of 220, that's a hedge fund. 2% fee flat. And if they meet certain levels, if they get returns above a certain level, they get 20% of that. That was the day that George Soros $1 billion. One day. 1992, he almost broke the Bank of England. He definitely got that 20%. When the article is entitled "The Trade of the Century," yeah, they hit their returns. Sometimes there's a lockup. One of the great movies that helps explain a lot of these concepts is called The Big Short. It was about the housing crash in 2008. I do advise people, and I warn them, it is not a feel-good movie. It does not have a happy ending. It likely is going to leave you feeling very angry at a bunch of people. But it's an incredibly good movie. And explains a lot of these concepts. There's a scene in there where Batman actually locks up his hedge fund. I say Batman because whenever I see Christian Bale on stage, that's all I just see, Batman, because clearly he is the best Batman. And I know statistically some of you have the incorrect opinion that somebody else is a better Batman. As long as you understand that you're wrong, you're welcome to that incorrect opinion. But anyway, Christian Bale was playing a character named Michael Burry. Michael Burry was the first guy who sort of realized what was going to be happening, and he made the bet. And there's a scene where he sends an email to all of his clients saying you cannot withdraw the money. And there's a bunch of emails back on. Signed up with his hedge fund. Now, if you've seen that movie or know what happened or realize why they would have made a movie about him, by the end they were not disappointed in what their returns were. But in the middle of it, they were quite unhappy. Oh, where'd the ring go? I always put it there and lose it. Sometimes there are mutual funds that invest in hedge funds, called a fund of hedge funds. I believe with a Series 6 you can sell these. Let me rephrase. With a Series 6 you can sell these. I think that I don't understand. Hedge funds are risky enough trying to combine them into a fund of hedge funds, so you get normal people to pay these exorbitant fees, but not actually have enough focus to truly, you're never going to be selling them. You could, but you won't. You give me Flintstones. If Great Light climbs up sky tomorrow, I keep stones. If Great Light don't climb up sky, you lose stones. That's the first hedge fund. Heads I win, tails you lose. Pooled investments. There are many types. They are heavily tested. Primarily, we talk about investment companies. The most common you're likely to be selling and dealing with even in the real world. We talk about my boat and my warehouse in other classes. I'm not going to go through that whole story. We don't really have the time. I'm just going to try and sort of link them together when going through this table here. The idea is I'm having a boat. I'm selling 1,000 shares, a fixed number, maybe 5,000, 10, whatever, but it is a fixed number. I also have a warehouse that anybody can come in and buy stuff. There's an unlimited primary offering. Primary offering because I run the warehouse, I issue the stock, and I'm involved in every transaction. It's my warehouse. You want to get in, you got to come to me. You want to get out, you got to come to me. I'm involved in every transaction, primary offering. You can only buy full seats on my boat. You cannot buy 2.5 seats on my boat. Don't think Robinhood or Stash or Acorn or those where you can buy fractional shares. In this world, you can't. Open end, you can. You can buy as much of my warehouse as you want to pay me. We'll calculate how much my warehouse is worth, how much you're giving me. I've got to get paid out of a sales fee in there. And then I'll give you percentage ownership. You want to buy 5, 10, 20, 100? Sure. Well, you can't buy 100. 80, 70? 1.8273846? Sure. I just want your money. Fractional shares, fractional percent? Sure. Now, the closed end only trades on secondary markets. I'm actually afraid of water. I just build boats. I then ship them off. I'm not interested in getting on the boat again, and I'm certainly don't have any more seats to sell. You've got to go find someone on the shore who's buying and selling seats on boats. I'm not the only boat builder. This is not my only boat. There's an entire industry of people buying and selling seats on boats. You've got to go to them to be able to buy and sell the seat. Not me. I'm not doing that. The warehouse I mentioned already, I'm the only one with the keys. If you want to buy, you've got to come to me. If you want to sell, you got to come to me. That's why it's always primary offerings. I'm the only one with the keys. Everything goes through me. You need to recognize that when it comes to closed-end funds, they generally issue common stock. Open-end only issues common stock. Closed-end, unless the question's talking otherwise, also is common stock. But closed-end could issue preferred stocks and bonds. Open-end cannot. Closed-end are priced by supply and demand, how much people want the seat on my boat and how much they're willing to pay for it. If I have a $2 bottle of Purell 2 months ago, and there's a line of people out the door willing to pay me $20 for that $2 bottle, it's not a $2 bottle anymore. It's not a $2 bottle anymore. That $20 bottle, because the demand has driven price up. Open end, though, is always a fixed price system. This is technically a rough estimate. 65 is one of the classes where they may actually have you calculate pop. This is a rough estimate. If you are given NAV and sales charge, this is a rough estimate to find pop. Just remember to round up. Always round up. Never down, always up. And that's likely all you need. I don't recommend memorizing that ugly other equation. The chances of you seeing it are minimal. And if you remember this, it's generally good enough as long as you remember it is an estimate. And the correct answer will always be higher than what that is saying. Always. Just a little bit, though. Not a lot higher. Both have voting rights. Both have dividends. Only the preemptive, only closed end has preemptive rights. That's the idea. If I wanted to go and bring my boat back and add another seats, add more cabins, add more shares to my closed end fund, I could do that. But I've got to give my current seat holders, my current cabin holders, my current shareholders first right to maintain their proportional ownership. Mutual fund number of shares changes daily. If every time more shares were issued, I had to send out preemptive rights, that would literally be basically every day. Any questions here? So open or closed end, which is sold by prospectus? Oh, I thought this was going to load one at a time. Whoops.
Open end.
Just open it?
Is it every
This is
fund?
one that you want to be careful with. When I initially sold those seats on my boat in the IPO, I did so with the prospectus. Always open end. Every open end sale. But the first closed end must also come with the prospectus. If they're on an exchange, they don't. But if they're new issues, they do. What about being redeemable? Which ones are redeemable?
Open end.
Open end,
Actively managed.
open end.
Open end.
Just open end. Both can be actively managed.
Yeah, I was just getting ready to say that. I just realized that.
Now, there are a lot of times where the closed end is going to effectively be an ETF, which means it's not actively managed. Then again, there are a lot of ETFs that are registered as open-end funds, and so they're not actively managed either. Both can be actively managed. Which trades openly on markets? Oh, I missed.
Closed
Oops.
end.
Wow.
Closed end.
I messed up.
Okay.
It is closed end, not open. I don't know why I didn't. Wow. Sorry. It is definitely not. It is not. It is open. It is closed. Open and redeem. They do not trade. Fix. Wide.
Wow.
Whoops. Sorry. Investment company, diversified. They have to follow the 75-5-10 rule. That is, 75% of the assets must be invested, such that no more than 5% of the assets are in any one issuer, and that no more than 10% of any one issuer is owned. There are no restrictions on the other 25%. Here's the chart that's going to make that hopefully a little easier. And I get to tell Prime my favorite story that doesn't really matter, but it's just funny. So this is the entire account. We're only caring about this 75% of it. We're going to zoom in and we're looking at that right here. The idea of this 75-5-10 rule, the 5, is that I've got to invest in at least 20 companies. If I put 5% in A and B and C, and I'm going to put 5% in T, and I'm out of money. Remember, the idea of diversified is, in one way, not all of your eggs in one basket. I need at least 20 baskets because of that 5% rule. Now, the 10% rule. I can't buy more than 10% of the shares of any one company. Let's say I was a manager of a company with $200 billion. 75, 5%, blah, blah, blah. It's about 10 billion. That means I could put, theoretically, $10 billion into any company. That's not more than 5%. But if I have $10 billion, that means I could literally buy any small and most mid-cap companies. I don't mean controlling interest. I don't mean buying 50 plus 1% of the company. I mean 100% everything that company is, I could buy for $10 billion or less. So if I went and did that with, let's say, 30 or 40 companies, and I went and bought 30 or 40 companies, I now own and control them. Is that diversified? Because I could make a mistake that would then ripple across. The one that I like to talk about is Hulk Hogan. Hulk Hogan, and I think it was the early 90s, was given the option to put his name on 2 products. Now, I'm sure I don't need to tell you guys this. You guys all have this, that he chose the Hulkamania Meatball Maker, a great device, as I said. I'm sure everyone has one in their kitchen. But there were 2 options. The other one that he turned down was this weird little, this grill that's supposed to be like a grill in the kitchen. It's like angled so like the fat drains off. I mean, who would want something like that? So that company went to their second choice spokesperson. Hulk Hogan turned them down. So they went to a guy some of you may have heard of, named George Foreman. George Foreman, last I looked, made between $500 and $800 million because he said yes when Hulk Hogan said no. And if Hulk Hogan said yes, I am quite sure I would have a Hulk Hogan grill in my kitchen right now and not a George Foreman grill in my kitchen.
I have a Foreman.
Everyone has a Foreman. That's the idea as well. In 2008, I think it was 2008, Blockbuster was offered Netflix. Blockbuster could have bought Netflix for $50 million. $50 million. And Blockbuster went, that's a stupid fad. We know that for the next 50 years, everyone's going to want to drive 20 minutes to a store that likely doesn't have the movie that they want and have to drive 20 minutes back to return it. No one's going to want this convenience of being able to watch at home. $50 million for Netflix. Yahoo could have bought Facebook for $100 million. There was a company called Lotus 123 that said no to an offer from Bill Gates. That's why you don't know what Lotus 123 is, because they said no. If they said yes, you would not be using Excel. You would be using Microsoft Lotus. And you would know what Lotus was because you'd be using it. Sometimes businesses make horrific mistakes. If I own 20, 30, 40 companies fully outright in my mutual fund, and I made a really bad mistake, like Hulk Hogan saying to the meatball maker that you can't even find them on antiques on eBay. They made so few of them because they were such garbage. You can't find the boxes anymore. You can find pictures of it, but that's the closest you can generally get. That if I can't control more than 10% of the company, that means if I do a major screw up and believe that, yeah, we should choose the meatball maker, the other 90% can look at me and go, you're crazy, and outvote me, and we still do it. That's the idea of the diversification. The key point to recognize, though, is it's usually one or the other. Very rarely is it both. The 5% is designed to make sure that small mutual funds are, in fact, diversified into enough things that if there's any given crash, it's not really going to math as much. Large mutual funds are the ones that have the 10% rule because they have enough money that they could just buy undue control of too many companies. And if something went wrong, all of them would sink. Questions here? And by the way, I do this slide in my SIE class, not because it's actually tested on the SIE. I just really like talking about Hulk Hogan and his meatball maker. I just love that story. It was a pasta maker. I was telling you it was a pasta maker for a couple of years until I actually looked it up and no, it was a meatball maker. Either way, whatever it was. But yeah, I think they said, I think the article I read said that George Foreman made $20 million in his career as a boxer and somewhere between 400 and 800 million because he said yes to the grill. REITs, equity REITs. REITs make money buying and selling, managing property. This is a real estate investment trust, REIT. Mortgage REITs make money dealing with mortgages. Hybrid REITs do both. They are organized as a trust, a real estate investment trust. Go figure, it says it right there. REITs can avoid corporate taxes if at least 75% of the income is from real estate and distributes at least 90% of its money. Now, why would all of it be from real estate? Well, the issue is at least 75 has to be from real estate because you can't have no limit, in which case you might have me claim to be a REIT to get the benefits and I don't make any money off of real estate. Then again, you might have certain REITs, say the one that I'm familiar with, I believe it's the PA REIT, Pennsylvania Real Estate Investment Trust, which owns a building called the King of Prussia Mall. Some of you may be familiar with that. It is the largest mall, legitimate mall in the country. Roller coasters and golf courses don't count as being part of a mall. Anyone living in Minnesota, you can just, I don't care about your golf course. Pure square footage of stores, King of Prussia is the largest. But anyway, they also have clothing and they have other things that they sell besides just managing the mall, charging rent for the real estate of the stores. They sell clothing and other stuff. That could be where some of that up to 25% could be. Distributions are ordinary income. The owners hold an undivided interest in that pool of real estate. Well, it's a mall, whether it's strip mall or inside mall, whatever. Whether you could be flipping houses. Real estate. Many REITs do trade on the exchanges or OTC. Some do not. If it doesn't say listed, it doesn't. But if it says listed, it's just like a stock. It trades just like stock. It has the same liquidity of as IBM stock. REITs are not investment companies. REITs pass through gains, not losses, which means they are not DPPs. Investment trust. This is a fixed, unmanaged portfolio used for appreciation or income. Unit is going to be $1,000. It's usually redeemable, but they can trade. Some can trade. There is no board of directors. They might have board of managers, trustees, but not directors. The word director is not here. Variable annuities and some ETFs are registered as unit investment trust. The separate account of variable annuities is generally a UIT. Exchange traded fund versus closed end fund. ETFs are indexed always. And I'm pretty sure always. There may be some that are not, but man, I don't know of any. They're going to have lower fees. They're automated. ETFs are transparent. Closed-end funds, not necessarily. ETFs usually trade at basically NAV. Maybe slight discount or premium, but very slight. Closed-end funds trade at premiums and discounts, not slight. They could trade at significant premiums or discounts. ETFs have no leverage. Closed-end funds can. Most ETFs are now registered as open-end funds, but can be closed-end or unit investment trusts. But you just want to consider them my boat. Think of them as a closed-end fund for any question other than the difference between ETFs and closed-end funds. They both trade on exchanges. They both are effectively priced by supply and demand, although ETFs rarely break that. Very, very rarely are they outside that. Closed-end funds can spike. ETFs really can't. Any questions? A stop order. There is a trigger price. That is the price on the ticket. That is when the stock trades at or through that price, it becomes a market order. Market orders will always place at the next available price. It goes to the bottom, and when it gets to the top at the first list, it goes off and you place. It executes. Execution price. This is the actual price that's paid. It does not have to be, it could be higher, lower, or equal to the trigger price. Because once it's triggered, it becomes a market order and it will place at the next available time. We'll always execute if that trigger is hit. That's important because the next one we talk about may not. The limit. The limit is going to be a price or better. Buy limit, I will buy it at this price or better or lower. A sell limit, I will sell it at this price or better. Higher if we're selling. We'll never execute at a price worse than that limit, but make sure that you do pay attention and spend at least some time thinking about buying at a price or better versus selling at a price or better and which direction that is. If you want to buy something at 50 or better, you'd pay 40 for it. That's better than 50. But if you wanted to sell it at 50 or better, you wouldn't sell it for 40. That's not better. You'd sell it for 60. You'd sell it for more. Make sure you pay attention to that. They can be a little weird. May not actually execute. Even if that price is hit, if the market bounces in the wrong direction, you will not pay a worse or pay or make a worse price. It will not execute at a worse price than the limit. which means it might hit, bounce off, and never get down there and never execute, even if it hits. A stop limit combines them. I mentioned that a stop order becomes a market order. Well, a stop limit becomes a limit order. It effectively puts a barrier. Once it goes depending on which side it is, if you're above, the idea is once it goes below, it becomes a limit and it won't place unless it stays above that line. You could do a stop limit from below, in which case once it hits this price, it executes as long as it stays below that price. It sort of sets the band, in which case it'll execute up here or down here as well. But it will not here and it will not here. Slabs and bliss. Sell limits are above, buy stops are above. If the current market price is 50, you'd set these at 60 maybe. Buy limits are inferior, that means below. Sell stops are also inferior, below. If the current market price is 60, you might set these at 50. The issue comes with some of these is the thinking logically about them. Two of them are rather easy. These are the long positions. These are the shorts, generally. One of the key things to understand about a stop is it is known as a stop loss order. Buy or sell, I don't care, it's a stop loss. Its current market value is at 100. I'm worried it's going to fall below 90. I don't want to be watching this, so I might do a sell stop at 90. Just so if it falls, we'll just stop the loss. I don't want to hold it anymore. That also means, let's erase this. That also means that this is a stop loss. Why would you need to buy something to stop a loss if you're short? Because as the price is going up, you're losing more and more money. So you would set the stop loss above the current price. So once it reached that level, you're like, ah, screw it, I don't want to lose any more money, stop the loss. Questions here before we go into, I think I've got one or two questions, samples, or my own questions here. So quick check. At what price would a buy stop 50 actually purchase at?
$55.
Remember, we did this is a BS, that's going to be slabs. So it's above. And we put it at 50 and it's 48, so it makes sense. It's above. Okay, everything seems to check. It goes, once it hits 50, now it's a market order.
50.5.
Next available price.
55.
It's not going to place at the trigger price. What about what price we actually purchase at? Again, buy limit, that's bliss. So it's going to be below. We're at 50. We put it with 55. We put it 50. Checks out. Okay. What price would this actually trigger at or execute at?
$53.
Really? Is 53 better than 50?
It wouldn't activate.
Make sure you pay attention to that with limits.
Yeah.
The test will get you, or try to get you at that. It doesn't execute. It triggers. If it stayed below, if this one was like 49.80, you'd say there. But it doesn't get, it gets worse. It hit and then bounced the wrong direction. Means it will not execute. How about you bought shares in BMK at 10, now at 30. We're going on vacation for a month, and I don't want to constantly contact my stockbroker and see, and I'm worried it's going to drop. I'd like to get at least about 25, which I do.
When you buy a stock, 25.
Buy?
Sell limit 25.
One of these to understand, I own the stock, right? I bought it. If I want to get out, I have to sell.
Okay.
I'm not just buying more stock. I want to sell it.
Sell a limit at 25.
We can look at slabs and Bliss. We have a sell limit, and a sell stop. And we're at 30. And we're looking at 25. Is that above or below 30?
Below.
Now let's just say, let's think about this one. What is that saying? That is saying I want to sell it for at least 25. Oh, that's a perfectly valid order.
Okay, I
But
get
if
it.
the market's currently 30 and I want to sell it for at least 25, why wouldn't I just sell it now? Why wouldn't I just put a sell market in? Why would I put any kind of limit or stop in? Why wouldn't I just sell? This is already better than what what this would get me.
Yeah, why not?
These orders get weird. Breathe through them, try and eliminate silly answers that if you sort of stop and think about them, these are ones where you may want to just mark them and come back when you know you have the time. They are weird.
So you do something like this if you just didn't have time to watch the market the whole time, pretty much.
Now, again, in the examples that I'm giving, or what Kaplan or FINRA is going to give you, they're going to give you big differences. The stock's at 50 and we'll put a limit in at 40. Or in the real world, it's going to be dimes, nickels apart, because they're trying to like really time that. They want it at 50.06 or 50.09. If it's 50.10, that's too much. If it's 50.06.5, well, now they're not really interested in that either. They just wanted this, and they get much more like if you go and look up real world examples of these, it's tiny differences that can be very hard to visualize. So we stretch it apart so you can sort of see how they work. This is not a realistic real world situation. Collateralized debt obligations, CMOs, CDOs, collateralized debt, collateralized mortgage. This is the other side of a bond, basically. Instead of a person loaning to a company, this is the person borrowing. The person pays monthly payment that goes into the pot. Monthly mortgage, monthly debt installment, whatever. Each month, that money that goes into the pot flows to each of the investors of the CMO, CDO. If rates go down, people will prepay the loans. If interest rates decrease, people refinance. You get your money back earlier, which is a prepayment risk, because now you need to invest your money in a lower interest rate environment. The pot is segmented into tranches. If you see CMO-CDO. No, I didn't get this ready. I'm pretty sure I included it correctly. There's notes in online. I'm pretty sure if you turn the page, you will see it. Oh, no, that's not what I want. Oh. This up, move over. Let me go and find it just so I can show you guys what it is. Make sure we see it. Actually, about almost done. Don't. What happened last time? Because last time we were like 15 minutes late, now an hour and a half early. I say I would rather let you guys out early and give you guys more time to do other things than say the schedule is going to be done at a certain time and have to hold you late and maybe make you miss things. That's my logic, at least. This is what you guys should have in the notes. Sort of a list of different investments, alphabetical, why people would want to include it, the risks
Yes.
that are associated with it.
Yeah,
Yes, got it.
Last time I messed that up in the book, so this time I did fix that. For the July class, I messed that one up, but fixed it here. So it talks about, we didn't really get into the DPPs. They're more tested on the SIE too. They're a partnership. There's a general partner that runs the day-to-day. Limited partners are just the money people. Jeff gives the example of, imagine if I wanted to go and start a restaurant and I'm looking for money to help with the restaurant. I'm the manager. I'm the one that's going to be cooking the food or picking the chefs and helping with the menu and all that. You guys are just giving me money and collecting. I send out part of the profits each month to the investors. You would be a limited partner and you'd have limited liability.
Is there any correlation between DPPs and like venture capital, or no correlation at all?
What do you mean by correlation?
Just meaning like when I was reading venture capital, I kind of thought of them as DPPs.
You might be able to have venture capital firms set up as a DPP.
Okay.
That's what I'm trying to figure out, like what you mean by there, how it might be tested. It's not likely.
I was just trying to remember the definitions of the two, and I was just saying, hey, well, when I was reading the definition, I kind of thought
that's sort of, it's to a degree what you're saying is like a auto mechanic has to be a S corp. Like, well, no, I mean, an auto mechanic could be an S corp. They could be a sole proprietor. They could be a partnership. They could be lots of different business structures. You're, I think, mixing up the purpose of the business versus how it's structured. We're going to be talking about that a bit more next week as well, because business structures are important on this. And the idea is, to a certain degree, we're going to talk about partnerships next week, which are related to DPPs because they're usually, actually I think they may always be in a partnership. DPPs, I think, are always forms of partnerships. But what the corporation does, just because you say like, oh, it's a corporation. So what does that mean? Does that mean that they make computers, that they make cars, that they teach people how to pass securities exams, because the securities guys is a corporation as well? I mean, it's a business structure as opposed to like a purpose kind of thing. Does that make sense? Does that help explain what you may have been thinking about as the correlation or the
yes.
Similarities? Yeah. That's for today. As I said, last week we finished at about 3 o'clock. There were several other days where we went past. That's why I extended to 3:30, just to sort of